ESTR NTME, the 23rd of June 2026, a date destined to be etched into market history. Black Tuesday. Global tech stocks were hit by an unprovoked bloodbath. The Nasdaq tumbled 2.21%. The S&P 500 fell 1.44%, both hitting one-week lows. And at the epicenter, the Filat Alp Haya Sam ICO NDU CTOR Index collapsed 7.87% in a single session. Micron Technology down 13% in one day. ARM Holding GS plunged over 10%. Applied DMAT Ariel's Texas Instrument, Test Qualcomm all down more than 8%. $1 trillion in market value erased overnight. So what happened here? Was this the complete collapse of AI phase or a long overdue froth squeezing correction? And who exactly drained the market as last drop of liquidity on this Black Tuesday? Welcome into this in-depth financial analysis. In the next 20 minutes, we'll dissect the conspiracy of three liquidity drain forces behind this storm and the pivotal moment ahead that will determine AI's fate. Let us rewind to that trading day. Every single one of the 30 components in the Filat Alp Haya Sam ICO NDU CTOR Index fell. Not a single stock was spared. SIS wasn't a company-specific blow-up. It was a systemic collapse of an entire sector. At the center of the storm was Micron Tech. Analog Y over the past year, it had surged more than 800%, earning the title of 10-bagger king. Its market cap once exceeded $1 trillion, but in a single night, it lost 13%, equivalent to wiping out an Intel or a Qualcomm. But that was just the tip of the iceberg. Beyond memory chips, optical communications, and semiconductor equipment sectors were also decimated. Credo and Co-H R&T tumbled over 10%. Marvel Technology Y fell over 9%. SIS wrote respected no borders. Sati same day, South Korea's Chorus Pi plunged 10%, triggering a circuit breaker. Samsung GLU, Control Oni CS, and SK Hynix X both fell over 12%. Taiwan's TaiX and China's ChinaXT also suffered heavy losses. SIS was a synchronized global retreat from AI assets. The question is, why Wall L-Star ETS? Answer is simple. The market ran out of money and the AI narrative began to scare people. We can attribute this sell-off to the convergence of three forces, or rather three blows. The first blow came from the largest IPO in history, SpaceX, on the 12th of June. Elon Musk SpaceX officially listed on the Nasdaq, raising $75 billion at a valuation of approximately $1.77 trillion. SIS was the largest IPO in human history, bar none. But the truly staggering number is this: it attracted over $250 billion in subscription demand. That is more than 3 times the offering size. To free up cash for SpaceX, institutions had to sell their most valuable holdings, Micron, Nvidia, ARM. And this is just the beginning. OpenAI and Hydropeak and other AI darlings are also queuing up for IPOs. With combined financing needs approaching $200 billion, SpaceX's single IPO alone raised more capital than the entire US IPO market over the past 2 years combined. While LSTRE is witnessing an unprecedented great capital rotation, the second blow came from the former market guardians, the tech giants. In the past, whenever tech stocks dipped, Apple, Google, and Meta would step in with buybacks to support prices, but now the tables have turned entirely. To fund their AI arms race, these giants have not only halted buybacks, they've started issuing new shares en masse. Amazon, App, Microsoft, and Meta, these 4 companies alone are expected to spend $750 billion in capital expenditures this year. Where is that money coming from? Increasingly from debt financing. The tech giants that once relied on strong cash flows to weather rate hikes are now transforming into heavy asset industrial enterprises. The IR free cash flows are shrinking and their dependence on external financing is soaring. The market as largest buyers have suddenly become its largest sellers. This logical reversal is a key driver of the crash. If the first 2 blows were regional hemorrhaging, the third is the true rug pull. Fed era LRS RVE rate hikes. New Fed Chair IR Kevin Walsh struck a distinctly hawkish tone, leading markets to begin pricing in a scenario where instead of rate cuts in 2026, we could see 2 rate hikes. Bank of America projects 3 consecutive hikes in September, October, and December, each by 25 basis points. What do high valuation tech stocks fear most? Raise in rates. When the risk-free rate climbs from 4% to 4.5%, those distant, uncertain future AI profits suddenly become worth far less in today's dollars. More critically, this shift in rate expectations has fundamentally altered the market as trading logic. The low rates narrative that underpinned the 2-year AI bull run is being torn apart. The market is pivoting from trading geopolitical risk to trading interest rate risk. Even gold and silver are falling. Every HNG is selling off except the dollar and Trey SU recess. Capital L is fleeing all risk assets and rushing into the safest havens. But is this sell-off really just about liquidity shortage and rate hikes? The deeper reason is that AI trades had become too crowded. Morgan Stanley analyst stated flatly that AI-related trades had become overcrowded, making a sharp reversal all but inevitable. Goldman Sachs also characterized this as a healthy frost-squeezing correction. Let us look at some data. The both Merrill Lynch Global Fund Demand HR survey shows that the most crowded trade in June was Longi Global SMEs at 80%. The second most crowded trade, Longi Mag ICE 97, came in at just 12%. ACC research report noted that long positions in the FILAD, App HIASM, ICONDUCTOR index and Taiwan TAIEX had become extremely crowded, sitting above the 90th percentile historically. South Korea, SCOS, PI, and Star R50 were also in relatively crowded territory above the 80th percentile. In China, the US, and Korea, the top 10% of stocks by trading volume are almost exclusively AI-related. The turnover concentration of these stocks has surpassed the 98th historical percentile across all three markets. What does this mean? It means almost every dollar in the market is chasing the same AI. On CE the tide turns, this becomes a collective stampede. We've seen this everyone's a genius sentiment before in 2015. China as a share-leveraged bull market saw turnover ratios and margin financing volumes surge in tandem, but that rally lacked earnings validation and Dell ragging triggered a cliff-like collapse in 2000. .com bubble saw Cisco, Intel, and the 4R SAM in trading at PE ratios of 82.7x, and when it burst, it left nothing but wreckage size time. Even the Buffett in the IC towards the ratio of total stock market capitalization to GDP has soared to an all-time high size metric, which Buffett himself regards as his favorite valuation gauge, has been flashing red for some time. Even more alarming is the massive leverage hidden within the AI supply chain. The Hongji listed ETF tracking SeiHanX, for example, swelled to $17 billion in ARM, becoming one of the largest ETF in the local market. In South Korea, retail investors' margin borrowing surged to levels not seen since just before the 2000 .com crash. On CE, the direction reverses. This highly concentrated leverage money will amplify losses like an avalanche. RBC below, EBA West Chief FTR 8G put it bluntly. We and tech stocks have risen too fast, and leverage and retail participation continue to heat up. The market Dow S&T need much of a negative catalyst to trigger a sharp adjustment. After years crash, the big question is this the end of the stampede or just the beginning of a deeper abyss? All eyes are focused on today. Micron Tech, Schnolog-Weiss fiscal Q3 2026 earnings release. Thursday's earnings report has been dubbed by Wall Street as the ultimate stress test for the AI rally. Why Micron? Back SE is the pick and shovel seller for AI infrastructure over the past year. Memory chip prices have skyrocketed and Micron's profits have grown exponentially. Market expectations have been maxed out. Adjusted EPS is projected at $20.57, representing a year-over-year surge of nearly 1,000% in the run-up to earnings. Investment banks have been aggressively raising price targets. Wedbush jumped from $550 to $1,300, Stifel to $1,500, Deutsche Bank K to $1,500, while L-Star ET has priced in all the good news. Told A Micron's contribution to S&P 500 earnings is second only to Nvidia's. Without Micron and Nvidia, the overall earnings growth rate for the S&P 500 would drop from 22% to just 14.9%. Micron is no longer just another chip company, it's one of the earnings pillars of the entire US stock market. The open question now is, can Micron's next quarter guidance come in even higher? Current consensus expects growth to decelerate to 7.25% next quarter, and further down to 54% a year from now. If the report merely meets rather than significantly beats expectations, the stock could still fall. This is what's known as expectations gap. SME analysts believe Micron will significantly exceed expectations. Others worry this could be the peak of earnings growth. Micron's report will be the ultimate litmus test for whether AI infrastructure demand can support current valuations. In the aftermath of Black Tuesday, the market is deeply divided. Goldman Sachs calls this a healthy frost-squeezing correction. Morgan Stanley says it's the inevitable unwinding of an overcrowded trade, but in the Chinese market, even more radical voices have emerged. Yan Jidongji, founder of the prominent private fund NingQNSET, wrote in a letter to investors, "We severely underestimated the bubble that AI infrastructure investing could create. We dare not participate any further." He compared the current market to the mindless buying frenzy of 2015, warning that many AI high flyers could lose 80% or even 90% of their value. As ordinary investors, how should we approach this? First, AI's long-term narrative remains intact. but short-term liquidity constraints are stretched to the breaking point. On one side, SpaceX and OpenAI are vacuuming up $250 billion in capital. On the other, the Fed may deliver consecutive rate hikes. The pond is shrinking even as the fish inside keep growing. Second, avoid crowded spaces and never use leverage. CSIS research notes that high crowding itself, though isn't necessarily signals the end of a trend, but it significantly changes tail risk dynamics. If fundamentals are disproven or liquidity conditions tighten, concentrated unwinding will amplify price shocks. For retail investors, being overweight in such crowded assets presents a severely deteriorated risk-reward profile. CIRD look toward broader structural opportunities. CIC suggests focusing on relatively less crowded segments within the AI space, such as memory, gas turbines, select semiconductor equipment and materials, and outside AI sectors with cost advantages, including chemicals, new energy materials, and undervalued cyclical sectors may also see valuation recoveries. Black Tuesday is both a warning bell and a litmus test. If Micron's earnings disappoint tonight, a bigger storm may still lie ahead, but if it holds up, this could turn out to be a golden buying opportunity in the AI bull run, provided, of course, that you weren't trampled in the stampede. What do you think? Has the AI bubble burst? Will you buy the dip after Micron's earnings or head for the exits? Share your views in the comments, like it and subscribe. We'll deliver in-depth analysis the moment Micron's earnings are released. See you next time.